Welcome to our webinar this month. As you can see the topic there, pick up investment tips around the braai. So why I use the word braai, this month South Africa celebrates what we call Heritage Month, Heritage Day. It was actually last Friday, the 24th. And whether it's crayfish on the West Coast or boerewors in the Free State or shishinyama in KwaZulu-Natal, coming together around the braai is how South Africans connect. Okay, so that is where we share stories, and that's also where you pick up the few stock tips from the self-appointed investment guru in your social circle. So the whole idea today is that you should be careful about blindly following the advice of the hot stock. You know, it's usually the guy that has the inside information from someone that works at the company, that kind of stuff. But the whole idea here is, and the gist of today's presentation, never buy shares on hot tips alone. Only buy after you've thoroughly researched the company. In other words, you've done your homework on the share. And the best way to protect yourself is ask yourself a question: would I have bought the share without the tip? If the answer is yes, then it's a great tip. Okay, that's obviously after you've done your homework. But the whole idea here is that you should do your homework before investing, because you need to know the risks about the company, or about the share, or about the asset, okay, that you're investing into. And you should never just be chasing short-term performance. Okay, so always adjust. I found this is one of the best ways to learn, especially if you're a novice or just beginning. Always justify your purchases. Okay, every time you buy and sell, every time you transact, by backing them up with reasons, solid reasons why you bought the share and why you sold the share. Okay, so write down those reasons. And the idea is, with hindsight, we can learn from it, and it can either be a success or mistakes. And I've learned more from my mistakes than I've done from my successes. Okay, so that is, if I can give you a tip, write down the reason for buying the share. If you only can write down one reason, I've got a tip from Jan. You haven't done your homework. Okay, so right off the bat, I'm going to give you a tip. Okay, investment tip. No, I'm going to give you a tip, and this is a bit of tongue-in-cheek, but the idea is that you must look left and right when you cross the road. Okay, so that's my tip. I've done it now. Okay, so let's get started. Going to the agenda. Let me just move my mouse forward. So we're going to talk about the whole idea that today is I'll be discussing investing and trading tips. I'm going to mention specific companies. I want you to do your own homework. I'm going to show you how you can use the tools to do your own informed decisions, and maybe around the braai next time you're the one giving out the tips because you've done the homework. Okay, so those of you that are complete novices, I know that some of you on this are new to the investment game and to share trading or share investment. So this is for you. 6 investment tips for beginners or a novice. That's another way of looking at it. So first of all, obviously set a goal. I find a lot of people, when they phone me, they just open up a share trading account, and the first question I ask them is obviously, yes, they want to make money, and I ask them, how do they plan to make money? In other words, what is their strategy? A lot of people don't understand that investing and trading are 2 different ways of making money on the market. You need to set yourself a goal and say to yourself, okay, I want to build up a portfolio, long-term portfolio for me to retire on one day. Or I want to build up a portfolio where I can live off the dividends for my investments. So the whole presentation today, obviously the context is share investment, direct share investment. We're talking about having an equity portfolio. So that's what I mean by that. But the idea here is that your time frame should also meet that objective. If your goal is a short term, then you see yourself as a trader, and that goes on to my next question just now about managing risks. If your goal is less than 3 years, you're a short-term trader, because then your strategy is more buy and sell, as opposed to a buy and hold long-term investing. Okay, so your time frame must meet your goals also. So if my goal is to build up enough capital for me to retire on, your goal needs to be long-term. When we say long-term, it's 5 years plus at least. Okay, so talking about managing risks, as a beginner, it's very important that you should always analyze the risk. And it starts off with your risk profile. You know, when you first start out in the market, you obviously don't have a lot of knowledge and experience, and you're going to make mistakes and things like that. So yes, there's higher risk, but as you gain more knowledge, learning about the market and learning about the companies you're investing in, you're going to bend the odds in your favor. And that's one way of managing your risk. But also saying that, we talk about buy low, sell high. Okay, that's another way of managing risk. But we talk about you want to imagine a quadrant where 4 quadrants where there's low risk, low returns. That's what we call a conservative investor. The stock market might not be for you. Maybe you must put your money into unit trust, into money market accounts, and that kind of stuff. So that's what we call a conservative investor. Moving up the reward scale, now we're looking at high rewards, low risk. That's what we call a prudent or wise investor or trader. Some of you have been on my presentations before. We have spoken about it. And that's where you want to position yourself. So what we call probability trading, those of you that are traders. You want to go for high rewards with lower risk. Okay, and then moving across, now we're going for high risk, high returns. That's what we call aggressive trading. Okay, some of you might be in that fold. You don't mind going on more risk, but you should never be in the last quadrant where you're going for low rewards at high risk. That's called speculating. Okay, so I hope that makes a bit more sense to you guys when I talk about risk. So it also comes down to obviously your age. The younger you are, the more risk you can take on. Also depends on your financial situation. One thing I can tell you is up front, you should never invest money that you cannot afford to lose. In other words, must never be the rent money. Must never be you've taken your children's education fund out and put it into the market. Must never be that money. Okay, we'll talk later on about the relationship of your money and how you perceive that money, because that's where the emotions come in now. Okay, we talk about greed and fear, and that's all got to do with that relationship of money. And it all comes down to, as I say, managing that risk. Then we talk about, your time horizon. The longer time horizon, the more risk you take on. And the share market historically has given you the most returns compared to putting your money in the banks. Okay, we all know that kind of stuff. So the shorter your time horizon, especially from an investor, and then you rather look at unit trust, rather put your money into a unit trust, into a money market, diversified income fund, that kind of stuff. But as I say, in this context here, if your view is 5 years plus, then we're looking at the equity market. Okay. One way of managing risk is by diversifying obviously, first of all, your assets. Okay, so you're not going to have all your eggs in one basket. So you might have some of your money involved in property, some of your money involved in direct share investment, some indirectly through unit trust, being into a balanced fund, wherever the case might be. And you might even put some of it into cash. So we talk about the asset mix and asset allocation there. In this context today, as I was saying, we're talking about equities. Some people say, I want to have at least 50% of my assets in equities, going to go for the higher growth. So then you go one step further. It's okay, I want to diversify. I've got a local portfolio, but I also want to invest offshore. I want to diversify geographically. So, something happens here in South Africa, and he's got some money offshore. That's one of the reasons for going offshore. Secondly, obviously, investing to companies not available, sectors not available in South Africa. That's another big reason. Okay. So, diversification is very, very important. So it's what we call the spread, and we'll touch on it again just now. You want to be invested in the local share market across 3 to 5 different sectors, and maybe between 8 and 12 different shares. So you don't want to, as I say, don't put all your eggs in one basket. And then also, what's important as a novice, it's always good to pay for quality. Now we talk about blue chip shares, and we talk about green chip shares, growth stocks, and we talk about red chip shares. Excuse me, that's the reasons why we have that. So quality companies have been around for a long time. And there's our old expression, elephants don't gallop. So the company's been around for a long time. They also give you your 10% growth per annum, and they will give you your 3% dividend yield. Okay, those are the solid quality companies. Okay, so the whole idea is that you don't just want to buy a share on a low point. There's reasons why a 5-cent share is trading at 5 cents. Once upon a time, it was 5 rand. It's fallen from 5 rand to 5 cents because the market doesn't see any growth prospects. So be careful of those kind of companies. Those are the red chips I was talking about just now. Those really speculative, risky companies. Okay, and then obviously be patient. If your investment's performing poorly, don't just sell it. Do some research and find out why is the company falling. Do your homework. The market is unpredictable. And yes, the market is more volatile because of the uncertainty. but to have reasons, as I say, for exiting that out of that share portfolio, or out of that share rather. And then lastly, stay informed. And this is one of the most important things, I think, as a novice investor. It's just obviously gaining knowledge and experience, but also you need to be aware of what's happening in the market, why the market's performing as it is. And one of the better ways, especially those of us that are very, very busy, and those of you that are existing equity account holders that have equity funds with us, join our WhatsApp or Telegram groups, because that's one of the better ways to be kept informed. Another way is looking at our weekly, our daily, our weekly and our monthly newsletters. That's another way of keeping informed. And yes, there's a lot of other sources of information. Obviously, I use the Business Day online. I use MoneyWeb. There's a lot of information out there. Okay, so I hope that makes some sense for those of you just beginning. Okay, let's move on to into the actual gist of the presentation. So 5 essential things you need to know about every share. So I've broken this down into 3 different slides. Number 1, 5 general things, 5 fundamental things, and 5 technical things to look at. And this is where my tips are going to come to you. So going back to what I said early on, what do you want? People want to make money. How do you want to make money as an investor or trader? It goes one step further. If you're an investor and you accept it, I want to be buying and holding, you need to ask yourself, okay, what style of investor do I want to be? Okay, so I can be a value investor, like a Warren Buffett. He's a value investor. So we talk about value investing as one style. You might be a growth investor. You want to go for companies growing much faster than its peers and that kind of stuff. You might be investing to companies that are paying dividends. Okay, so or you want to have a combination of all those shares in one long-term portfolio. As a trader, yes, I could be buying and selling. So my view is more shorter term. Again, what style? You can be a position trader, holding a position for a few weeks to a few months. You can be a swing trader, holding a position from a day, maybe to 2 weeks. And some of you might go one step further and say, okay, I want to be a day trader. And those are the real cowboys. Okay, so it's not enough. If you're not going to do your research, you're going to make losses in the market. And that's what the point is I want to make today. If you don't do your homework, you'll make your losses. And that's the bad news. The good news is you can also learn to cut down on your losses by doing more research. But also, I'm going to show you tools that help you save time and help keep you more informed. Okay. So, yeah, most small investors, and this is I'm going to be brutally honest with you, most small investors do not beat the market consistently. Most small investors do not beat the market consistently. If it was easy, everybody will be doing it. Okay. But saying that, if you learn and apply certain ideas and principles and guidelines, as I said, you'll bend the odds in your favor. Okay. So it's not about making money in the market. I always want you to think there's 2 sides of a coin. It's not about making money in the market, it's avoiding capital losses. If I'm starting with 10,000 Rand in the market, I don't want to lose that 10,000 Rand. Okay, that's a worst case scenario. But also, it's looking at going one step further. And I looked at it this way. I was watching the rugby on Saturday. I heard a commentator say something, and I thought, oh, that's quite interesting. He said that they were talking about defense and offense. They said the best attacking team in the world at this point in time is the All Blacks. And the best defensive team in the world is the Springboks. And I thought, okay, there we go. So you want a combination of those 2 together in your portfolio. You want the best defense and the best offense. Okay, so as I say, is that combination. So I found that there's only 2 reasons why people lose money in the market, really. Okay, so number 1, you're either buying the wrong company. In other words, it's got no growth prospects. It's a speculative stock. I mentioned just now that 5 Rand share, now it's 5 cents. It drops down to 1 cent. What happens after 1 cent? It's suspended and gets delisted. So that's the first reason. The other reason is that it's the wrong timing. So you're buying at the top of the cycle. We talk about technicals just now. So you're buying at the top of the market. You have to wait a long time before you break even. And when you break even, you sell out. Okay, so those are just a quick way of getting in. So let's talk about 5 general things. And these are 5 important questions you need to ask yourself. 5 of the things, before you get started, you need to know what's the nature of the business. What am I buying into? And this is important to understand. Remember, we're not buying a share. You're buying into a company. You're going to become a shareholder. So that's one way of changing your mindset. So the first question you ask yourself is, how does this company make money? Okay, so the best thing to do is to go to the company's website. Go to, for example, Sasol's website and go look for investor relations. You always find a tab called investor relations, and on there, look for event or presentations, and that I find very useful. Go look at the past presentations, and also one of the best sources of information is the actual annual report. On Sasol's website, for example, I came across the integrated report. They call it the integrated report. It's a comprehensive report on the company, just everything you need to know. Okay, so the main thing is that you want to know here is before buying the company, you need to have build up exhaustive knowledge about the company. Yeah, what do they do? What do they manufacture? What service do they offer? Yeah, in what countries do they operate? So, in other words, is this a rand hedge stock, for example, or are they only local? What industry or sector do they operate in? Is it a mining and resource company? Is it a financial company, or is it an industrial company? Because ultimately, you want to build a diversified portfolio spread across all those different sectors. Okay. What is their flagship product, and how has it been selling? Yeah, are they a leader in this field? So these are some of the questions you need to know. So you need to look at the quantum as well as the quality of the profit that the company is making. In other words, we're looking at sustainability, especially in these uncertain times now. We need to look at sustainability, especially when it comes to profits and dividends. So you also need to look at things like the business model. Now, business models are changing. A lot of people have gone from, or a lot of companies have moved from bricks and mortar. They're moving online. They're having a bit of a hybrid, a bit of both. You have PSG Asset Management has this, what they always talk about, the 3 M's. Yeah, we talk about moat. In other words, it's the barriers to entry. What are the barriers to entry for this company compared to the competitors? What's their management like? And also, the last M is their margin of safety. That's the fundamentals we're talking on just now. So we talk about also the how do they continue making money? As I said, that's sustainability. So we're looking at the quality of the profits. Is that sustainable? Can they do it next year again? So you might be going to a company that is cyclical, but you need to take it with there's a pun in the market, pinch of sale. So if it's a cyclical company, be aware of those kind of things. But always, if you're chasing growth, always be careful of the variation. The valuation of the company is important. A 5-cent company can be expensive relative to its earnings, and a 500 Rand share can be cheap relative to its earnings. And we'll touch on it again just now. Okay, so the market always pays a premium for growth, and we'll talk about it again also just now. Step 3, learn about the sector in which the company operates. So you need to know, you go wide and say what's the industry, and then from there into the individual sectors. Okay, and then obviously the end market. So value buys, a value stocks, for example, may be a great idea when the market's flying or in specific phases of the market, but it's growth that assures you the sustenance. That's why I personally like to have I call it a fruit salad of shares in my portfolio, some growth stocks, some value stocks. But the whole idea is that your portfolio must be growing more than inflation. That's the worst case scenario, more than inflation. Historically, the market's the share market's grown between 10 and 12%. The ideal situation, I always say, I want to strive to have my portfolio making at least 20%. That means every 5 years, your portfolio should be growing, doubling rather. Okay, that's what I'm trying to say. Okay, and then check out the company's balance sheet. What's important here, especially now with this whole COVID scenario, going back to sustainability, we're looking at the health of the company. So more specifically, we're looking at the debt. You want to check out the company's indebtedness. A high debt equity ratio, the company can run into bad times. And there's talk about interest rates rising. When interest rates rise, companies feel the pinch. So I personally prefer to use, instead of using a debt equity ratio, on our website, we have a thing called interest cover. It's how many times can we pay the interest bill out of earnings. It's a large cap stock. If it's a top 40, we say 3 times cover. It's manageable. If it's a mid cap, I'll still go maybe 3 times cover. But if it's a small cap company, it's very important that you look at 5 times cover and things like cash flow, that kind of stuff. So balance sheet's important to look at. Okay, and then bottom line, no one can perfectly predict the share market's performance or a share's performance. Doing your homework goes a long way. At PSG Wealth, we have a research team that do all the work for you, but you yourself, no one cares more about your money than you do. So go do your own homework, as I say, go to the company's website, go download the annual documents and things like that. You might not understand it right away, but look at those presentations. You understand what the company does. Okay, so as I say, PSG is out there to help you, and on our website we have tools. So once you've logged onto PSG Online, you come across, this is PSG Online, our homepage. If you click on, if I can bring my cursor in here quickly, and my spotlight, there's a button there called Research Hub, and under Research Hub, you'll see there's a tab called Recommendations. So those of you that are looking for tips, okay, or those of you that are complete novices and don't know where to start, this is a starting point for you. So we are highlighting opportunities for you. So it's our fundamental recommendations. These are the best quant ideas. These are the large cap companies. So you can see Nedbank, Liberty, excuse me, quite a few well-known companies you'll see in that listing. So those are the large caps, and there's the small caps. Okay, and these are the latest research here. We also go one step further. We highlight companies that are undervalued. So I'm going to grab some water. So undervalued company, you can see they're all green. So based on the PEG ratio, we talk about undervalued, and I'll touch on just now again what we mean about undervalued. Those of you looking at companies for dividends, you can look at companies with high dividend yields. Okay, so this is a starting point. But let's have an example with the petrol price or the oil price hitting $80 a day or so ago. You think, wow, high oil price, high or a weaker rand, Sasol must be benefiting. Hey, look here, yeah, Sasol on the list. Okay, so yeah, because the PEG ratio is on 77, so that's what we call what is yellow. We say that's fair value. It's not undervalued, but it's fair value. If I click on the share code, okay, the share code takes me through to what we call the share info page. Okay, so yeah, it's a share info page. You can see that's Sasol. So on Sasol's web share information page, we get quite a lot of information. Obviously, we get the market info. Okay, the number of deals so far at this point in time, it was a snapshot. Bit of share information about the company. You know, the highest prices traded, the price earnings ratio, that kind of stuff. Or graph, you can see the trend, the last trades until that point in time. This is for today. Stock exchange news service, very important. You want to keep up to date with what's happening, what's any price sensitive information, anything that's related to Sasol. It's all one page. But if you click on that little link there, that little tab, research, and then I click on value investor, it goes one step further, where it highlights for you fundamental ratios and things like that. Okay, so this is where, let me put it this way. Those of you who are complete novices starting out, to simplify the market for you, you need to answer 3 questions. You need to know, what share must I buy, when must I buy, and when must I sell? That's all 3 questions that you need to do. Obviously, we make it a bit more complicated. We call it fundamentals. That's the what to buy, and the technicals is when to buy and when to sell. But the fundamentals, as such, what to buy, on our website, on the PSG Online website, is a screening facility or a filtering facility that you can scan the market based on certain fundamental criteria. Okay, so that's a big time saver, number 1, and number 2 is obviously highlighting potential winners for you. And ultimately, the whole exercise, before you buying the share, you want to create a watch list of the shares that you might be interested in. Okay, by the way, what to buy, when to buy is getting our timing right. And also a question, when must you sell? And there's a few reasons when to sell. And obviously from a investment point of view, we want to lock in our profits, but also, as I mentioned just now, is I want to minimize my losses before it gets too big. That's my whole objective. But also, I'd only sell a share if there was a mistake right from the beginning. I bought a share without doing my homework. Okay, and now the share's fallen, and now I want to cut my losses. That's one reason for selling. Or the price has gone up so fast that it's risen dramatically. It's at silly and unsustainable price levels. Only then would I look at, and also from a valuation point of view, it might be overvalued. I only then might put a 10% stop loss on. If it pulls back, I'll get out. Okay, we're talking about stop losses just now. But also, you know, if the share is dropping and you've got no cash available, we're talking about cash just now also, and a much better opportunity comes along, then yeah, it might be another reason for selling the share. I hope this helps you with that idea. So let's talk about the 5 fundamentals, what I like to look at. Okay. So Warren Buffett, there's a quote there from Warren Buffett. It is better to buy a wonderful company at a fair price than a fair company at a wonderful price. Okay. Another one of his famous quotes, and this is what me as a value investor, I live by: price is what you pay and value is what you get. So I'm a value investor. As I mentioned just now, a 500 Rand share can be cheap relative to its earnings, and a 5-cent share can be expensive relative to its earnings. So there's various financial ratios that you can use to help you determine if the share's cheap or expensive. You can use PE ratio. I like to use the PEG ratio and the price NAV. So we go one step further. I also like to bring in quality rating, and it's all done for you. We look at profitability. I like to use a return on equity ratio. I look at cash flow, and I look at dividends. Okay, so on our website, this is going back to Sasol again. Once you clicked on that on that research tab, you click on Value Investor. There's a tab here called Value Investing on Sasol. You can see it. The PEG ratio is 77. That's yellow. You can see on the legend here. That's what they call a fair value. Okay. So ideally, you want to buy into companies as a value investor with shares that are undervalued. You should never buy a share that's overvalued as a long-term investor. Okay. So if you click on the tab next to it, it's called Quality and Confidence View. You can see it goes one step further. Here's forecasts and here's actual. So what's so important here is that quality rating over here. You can see it's green. 80 plus would be green. Those are the kind of companies I'm looking at. Anything less than, I think, 75 will be yellow. Ideally, the higher the quality rating, the better. That just gives you that confidence in the company. Okay, so these are just tools to help you make an initial watch list of interesting looking companies. Okay, so being a value investor, you know, Warren Buffett is a value investor, what I call a bargain hunter, bit of a contrarian. You can see the quote right top there: be fearful when others are greedy, and be greedy when everyone else is fearful. So when everyone else is buying, you want to be selling. When everyone else is selling, you want to be buying. So being a bit of a contrarian, going against the trend. And one way to do that is to look at the companies that are out of favor of the market, not the hot stocks. Okay, so you want to look at companies that are out of favor of the market and dig a bit deep and find out why. Okay, so let's look at the technicals. So we spoke about when to buy, what to buy. Now we talk about when to buy. And my background as such, I'm more of a technical analyst, but over the years I've learned to combine fundamentals too. So I combine fundamentals and technicals. I have more questions to ask. It means I'm making more informed decisions. So the first thing you ask yourself, what is the trend when we're looking at the chart? The technicals, we're looking at the chart, and ideally I'm looking at getting my timing right. So yeah, we're looking at the trend, bullish or bearish. Bullish is higher highs, higher lows. Bearish is lower highs, lower lows. Okay, you can use various tools to help you to determine that, moving averages, trend lines, and things like that. Is it top or bottom? Remember, the market's cyclical. So the share might have reached the top of the cycle. That's what we call overbought. The bottom of the cycle is oversold. We use various technical indicators, be it MACD or RSI, stochastic, to help us determine that. Also very important to look at volume analysis. We use indicators called on-balance volume, volume price trend, to look at accumulation or distribution. I'll go one step further. I want to look at relative strength analysis. Is this share outperforming the market or outperforming the sector, its peers, or is it underperforming? And then last thing I want to look at is what price do I get in? Do I use a breakout above a certain resistance level? Why do I use chart patterns? As a trader, it's very important to know these 3 things: my entry price, my target price, my stop loss price. Stop loss, I won't be using as a buy and hold investor. I'm using more of diversification, that kind of stuff. So on our website, you'll find there's a tool called the Viewpoint Plus. Number one is a trading platform, but also as a technical analysis program. Yes, Sasol, going back to year, you can see it's trading above its moving averages, quite a few different moving averages. This green line here, if you can see it, that's a 200-day moving average. I want to see a breakup above that. At this point in time, yes, we have a bit of a recovery, but long term is still bearish. Okay, so things are, this is until yesterday when I took this little snapshot. You can see MACD here. So we are above that zero line. We are in overbought territory. Ideally, you want to buy when it's oversold, obviously way back here. Every time it dips, you want to maybe buy in. So now it's in the dip again. You say, okay, yes, it might be a bit more riskier to buy. So my target level will be to, first of all, break out above that, and then my previous resistance, my previous support level, you can see it quite a few times the touch there. That might be an ultimate target level. Okay, might pull back a bit slightly, but ultimately we need a break above there. That's the whole approach to the market. So importance of doing your homework. I hope you guys understand that it's your money. You have to take full responsibility. It's your money after all. The buck stops with you, as I would say. So every investment must fit into your eventual goal, be it I want to be a for my retirement, whatever the case might be. Only you know your long-term goals and aspirations. So again, don't just rush out and go buy shares on hot stocks. Okay, do your homework. Okay, so on our website, there's filters where you can use filters. Again, click on Research Hub, click on filters. Now this is going by sector. If I click on that drop-down list there, I can go by sector. So this is the banking sector. I can compare Nedbank to F&B and again use the various PEG ratios. I go one step further. I like to use price NAV. Okay, but say for example, I've already decided I want a banking stock in my portfolio. This is one way to compare and find out which one's a better one to look at. Okay, so first of all, I would look at Nedbank being the cheapest, and then Standard Bank, and so it goes on. Okay, you might look at the retailers, you might look at the food producers, etc. Mining sector. Okay, so that's one way of analyzing. You can go one step further also and say, okay, I want to use the search function. I can either, you can select these different criteria. I've got 12 different fundamental criteria to put in, okay? Or I can use the shortcuts. Yeah, I can just click on the button. I'm looking for undervalued quality stocks, and it's spit out a list for you. So yeah, you can see these are that's where we got a list early on with the recommendations. So as an initial starting point and dig a bit deeper. Again, click on the share code, and that's how you can build up a watch list of potential winners. Okay, so there's two ways to get involved in the share market. You can either do it yourself, what we call a self-managed share portfolio. I personally find this is is empowering for me. This is again a personal opinion. It is fun learning about the market. It's fun now teaching my daughter that just finished matric last year. She's starting to invest. It's fun teaching her about the market. Okay, so yes, it's fun. It just takes time. Okay, gaining the knowledge and experience. It takes time to set aside, create a watch list. Take time to do the research and things like that. But as you get to know the terminology, it gets easier and easier. So that's one way of doing it. Alternatively, you can also get expert management. You can hand your say to, here's my portfolio, take it over for me, and manage it on my behalf. But the main idea is that a financial advisor or a wealth manager obviously can look at it unbiased, unemotionally, and look at a lot of other things for you. Okay, so common investor mistakes. I'm running out of time here, so I'm just speeding up a bit. Common investor mistakes: not understanding the market. And again, Warren Buffett, there's that quote I mentioned just now. Warren Buffett is famous for saying, or he's famous for being cautious against investing in something he doesn't know about. There was, for many years, he never got involved in technology stocks because he didn't understand technology. And obviously he's learned about it, and I think the first stock he bought was IBM. Okay, so he's always advocated the ETF route or the unit trust route for those of you that don't understand the market. If you really want to learn about the market, obviously the whole idea here is do your homework. Okay. Another reason for people making mistakes in the market, they fall in love with a company. I know people that are still holding on onto these Steinhoff stock company, Steinhoff shares, hoping the company will go back to the 75 Rand. It's the same as the good old days. More than 20 years ago, there was a company called Data. People held on to that share, hoping that one day the share will go back to its high levels, and then it was delisted. Okay, we can see the same thing happening with Naspers and Process. Okay, so don't fall in love with the company. Lack of patience. That's another reason why people lose money on the market. The biggest enemy in the share market is human emotion, greed and fear. And that goes with my last point there anyway, letting your emotions rule. Your goal is to be objective. In other words, you look at the facts. You want to be in a situation where your personal opinion or be unbiased. That's important. So lack of patience is a big thing in the market. So you need to keep your expectations realistic. If the market historically grown between 10 and 12%, don't expect that you're going to double your portfolio every year. Yeah. The secret, I believe the secret to making money on the market is being consistently profitable. As a trader or even as an investor, consistency is the rule of the game. Okay. So investment turnover, be careful of that. If you're buying and selling, your costs of obviously your trading costs will be much higher. And secondly, obviously you must take in consideration the tax implications. So if your goal is to be a trader, yes, be aware of that kind of stuff, your income tax. I'd rather, as a trader, look at things like single stock futures and CFDs because your cost is much lower. Waiting to break even. That's when you got your timing wrong. You bought at the top of the market. Now eventually you have to wait to break even, and we call that it's when you have to sell a loser, and you're basically breaking even. In behavioral finance, they call that cognitive error. By failing to realize your initial loss, investors are actually losing in two ways when they do this kind of thing. First of all, they avoid selling the loser, which may continue to slide until it's worthless, or there's opportunity cost for the better use of those investment monies. Okay, so be careful of that scenario. Again, do your homework, fundamentals and technicals. Failing to diversify, we've touched on that already, and as I mentioned just now, letting your emotions rule. Your goal is to be objective. Look at the facts and things like that. Don't, again, as I mentioned just now, is that relationship with money. This cannot be your rent money. Okay. Your job is to take care. I always say it's stewardship. It's taking care of that investment. It's your retirement fund. It might be your fund to achieve financial freedom, whatever the case might be. So as a trader, there's also mistakes a lot of people make here. Trading without a plan. There's an old saying, fail to plan, and you try to fail. Plan to fail, and you fail to trade, or fail to play. Getting tongue twisted here. But anyway, you got the idea. Having a trading plan is very, very important. Why are you trading? Is it just to make money? Is it ultimately you're in a bigger full-time job? Whatever the case might be. Very important you write that down. And a trading plan is important, but also I go one step further and say have a trading journal. Remember, I mentioned my goal is such to be a consistently profitable trader. So having a trading journal, and with hindsight, I can look back and learn by mistakes. That's how you learn to make better decisions. Okay, trading too much too soon. We spoke about it also with costs. Okay, not using a stop loss order. When it comes to investing, we use diversification and obviously geographical investing and that kind of stuff. When it comes to trading, we talk about risk management. So number one, risk management we talk about is stop loss. Or on the platform, on the Viewpoint, we use contingency orders. And secondly, we talk about a position sizing. It's more useful for single stock futures and CFDs. You've got 100,000 Rand. The most you should ever lose on a trade is 2% or 2,000 Rand on your 100,000. That also dictates how many shares to buy or how many contracts to open. Okay, taking two big positions. If you're trading 50% of your money on one trade, it's like playing the roulette, pushing all your money onto black or pushing all your money onto red. And that's not a way to trade. That's what we call hope. Hope is not a trading strategy. Okay, and having too many positions is another way of people losing money. I find that it's like herding cats. You can't have a lot of positions open. 2 or 3 or most maybe 5 positions open. Remember, it also depends what market you're trading. If you're trading single stocks and CFDs and trading currency futures, and it gets a bit hectic. You get very confused with all the information, trying to keep up to date with it. Just additional stress you don't need. Okay, so be aware of those kind of things. Guys, let's I've run out of time. Bottom line, next time you're standing around the fire and having a braai, I suggest, and this is what I've learned over the years, is for me to be the one asking questions. I ask questions, obviously to start conversations, to obtain information, and to show any interest in other people's ideas. So the guy's talking about the market. He doesn't know I'm involved in the stock market. I want to know where he's got information from, how much homework he's done, and that kind of stuff. So my goal is to find someone that knows what he's talking about and then build relationships. I like to have a network of people and ideas. So next time you're next to the braai, having that braai, I always think of myself as you know, I'm a big fan of investment clubs, and the investment club principle works on other people's money, but also more importantly, leveraging of other people's time. So when you're at the braai next time and people are talking about the market, find out what they've done, you know, what homework they've done, how do they come across a share, what I've done in the past. So I hope that makes sense to you guys. So is why is it, where does this tip come from? Why is the guy telling you the share, giving you this tip? Okay, so in conclusion, before we handle any questions, you know, the legendary value investor, Warren Buffett's mentor, Benjamin Graham, he said it rightly. Investing is a simple exercise if you ask the right questions. Okay, so I have that mindset of asking questions. So these are the basic rules, as I say, that you need to apply to cash flows and business models and leverage. If you understand some of these guidelines and apply them, you will be successful in the market. Okay, so bottom line, you're 2 ears and 1 mouth, use in proportion, listen more, talk less around the fire, ask more informed decisions, and draw out the information. Okay, so I hope that made more sense to you guys. Let me see what kind of questions you've got, and we'll wrap it up. Okay, Yusuf, a way to join the Telegram group, send me an email. You'll see the best thing to do. Let me just quickly wrap this up this way. You can send me an email, Sean, VDB, SHAUN, and then VDB at psg.co.za, or send an email to wealth@psg, requesting that you want to be put onto the Telegram group. We do need, obviously, first of all, your cell number and your equity account number. Those are the two criteria we do need to put onto the Telegram or the WhatsApp group. Please stipulate which one you want. Okay, so cool. Let me see what other questions you guys got here. Please share the tool available for the PSG website for checking fundamentals for shares. So yeah, click on the share code. That's the easiest way. It takes you through to the share info page, and from there you can look at either the filter function or the search function. I hope that makes sense to you. Yeah, here's a question from you, Jan. What tips can I give you now? I think, Jan, you missed the point of this presentation. The whole idea, the tip is do your homework. Okay, so as a starting point, all jokes aside, Jan, the best thing to do is go to the PSG website, go click on recommendations on the PSG online website before going to the Viewpoint platform. Recommendations as a starting point, and as we said now, WhatsApp and Telegram is also important. Join that group. We put out investment ideas regularly. We give you market updates during the day and things like that. So sometimes we put out an investment idea. There's a PDF link to it. You can go look at that. We can also watch a short video. But that's one of the better ways to be informed. Okay. Margie wants to know about offshore shares. Margie, exactly the same principles apply. Obviously, creating a watch list if you've got an offshore portfolio with us. Recommendations also on the WhatsApp group, and same with Telegram. You can use a lot of other websites. Investing.com is great for information. Yahoo Finance, Google Finance. But as a starting point, I suggest create a watch list, look at the PE ratios, and then from there dig a bit deeper. Okay. So guys, I hope that helped you guys. Let me just close this. So in conclusion, those of you that haven't got an equity account with us yet and still considering it, go click on here. That gives you information. You can go the two routes, either self-managed or have it managed for you. But those are the two ways to look at it. Okay. So this presentation is being recorded. I'll be hopefully sending it out either late tomorrow morning or tomorrow late, or that or Friday morning. Okay. But from my side, guys, thank you very much for being on this webinar. As I say, there's our Wealth at PSG, about the Telegram or WhatsApp groups. Until next month, all the best. Bye for now.